Let's talk about the markets in 3 minutes. And let me start with the dollar question. You talked about the dollar weakness that we have seen, of course, this month and what else it's been affecting. We're seeing some pushback from some on your team, I know, around the extent of the dollar weakness. Where do you see that heading from here?
I'm really torn on this one. Look, the last few years, it feels like we go to the start of every year with the market getting very bared up on the dollar, and they keep on being disappointed on this. This year, the market's a little bit more nervous. They're not as complacent as prior years. There's definitely a slight bias towards the dollar downtrend starting next year. People aren't getting too enthusiastic about it yet. The problem is it all comes down to whether we get a US recession and the timing of that US recession. And as you guys know, I'm very much in the camp that a US recession starts around now. Well, next month into January, but this is kind of the kind of peak. And if we do get that kind of very sharp slowdown, that would normally be good for the dollar. Now, what I will say is that next year, I think, might be the first time in the last 20, 30 years, first time that I remember, that we might get a negative growth scenario that's not necessarily positive for the dollar. Normally, because it's the world's reserve currency, when there's deleveraging, there's a risk-averse environment, it means we're trenching back to the dollar and it's good for the dollar. That knee-jerk reaction will remain the same, but I think that ultimately, if we do get this recession, if we do get this turn, it's going to mark the end of US exceptionalism the last 15 years. And ultimately, that'll mean a lot of money flowing out of the US. So while it'll be knee-jerk positive for the dollar, I do think it'll start kicking off the more longer-term dollar downtrend again.
OK, so those are the stakes. It's about more than just short-term growth weakness. It's about whether US exceptionalism lasts. What does that mean for bond markets then, Mark? Of course, we've seen those yields coming down, particularly at the short end, which has been quite a marked development in the month of November.
Yeah, look. You know, I'm deeply in the camp that 2-year yields, we've seen the peak, they should come lower, that makes sense. They've come down very quickly, very fast. I don't think they're exciting to kind of play here from the long side of 2-year paper. If anything, if we don't get very bad data in the next week or two, the Fed is going to have to sound hawkish. They cannot let financial conditions ease this much. So either by the time of the Fed meeting, they have to go, yeah, growth's really bad, and that will justify the rate cuts, or they have to kind of go, oh, we're a little bit worried about how much financial conditions have eased, that's going to reignite inflation if we're not good at growth lending, so they're going to have to sound hawkish. So I think 2-year paper is a little bit harder here, and very short term, I can see there's probably more risk reward for yields going a little bit higher into the Fed meeting. But ultimately, I do think 2-year yields have peaked. The long end is more interesting because I think ultimately, because of my negative growth scenario that I think we're going to go into recession the next month or two, and I think it'll be a harder recession than people think, I think 10-year yields should have downward pressure next year. But I do think the curve will steepen significantly throughout next year because the concern about the US debt situation, US debt spending, will only be exacerbated because when we do go into a slowdown, the US leaders, government, will want to spend and increase the fiscal deficit, especially in an election year, and that'll increase pressure, upward pressure on the yields.